And the recording started. Hello investors, welcome to Business Learnings. In this video, I'll tell you how to generate at least 40% more returns on gold. You buy gold from the market and you hold it for some time, wait for its price to appreciate, and then you sell it. In the process, you make some profit margin. How do you increase this profit margin by more than 40%? And no, this is not I'm not cheating. This is possible with sovereign gold bonds, and I'll tell you everything about sovereign gold bonds and what's the process of buying, what benefits you get, and I'll cover everything in detail. So stay tuned throughout the video, and you'll get all the information that you need. Okay, let's start the video. uh, when you go to market and buy physical gold, you know you'll end up paying 10 to 20% of making charges, right? You cannot buy gold at the market price. You'll have to buy it through a jeweler or through an agent or through anyone, and they'll definitely charge you some commission, be it a making charge or just a plain commission, but you'll end up paying more than the market price, and in most cases it falls typically between 10 to 20%. And not just that, you'll also pay GST on it, 3% of GST on the gold price plus on the making charges. With sovereign gold bonds, you don't have to pay these. You don't have to pay the commission, you don't have to pay the making charges, you don't have to pay the GST, you don't have to pay even the selling commission. You don't have to pay anything because you're directly buying from the government of India. How do you buy it? I'll tell you in a few minutes, in a while, how do you buy a sovereign gold bond. But these are the numbers. If you buy a physical gold, you'll have to insure it, because you'll consistently be worried whether your gold is safe or not. Even if you go ahead and put it in the bank locker, you'll have to pay some charges for it. There is a mental tension involved here, which you do not see in, which you cannot put it in the numbers, but it's there. With sovereign gold bonds, since you are buying directly from the government of India, no insurance costs at all. Well, these taxes, long-term capital gains, short-term capital gains, if you hold your gold for more than 3 years and then sell it, whatever gains that you make, you'll have to pay 20.8% on that. Not exactly that, you get indexation benefits, adjusted for inflation, but this is what you pay. Again, why should you be paying anything if you can just have all the gains for yourself for free? And SGB, sovereign gold bond, gives you that flexibility. You don't have to pay any taxes. Short-term capital gains, your tax slab. Yes, if you sell your gold within 3 years, you'll have to pay your short-term capital gains. This is the case with physical gold, with gold ETFs, with gold, your sovereign gold bonds as well. Chances of getting cheated, well, if you go and buy physical gold, no matter how clever you are, there is always a little chance that you might get fooled and you won't even know it. So why risk it when you can buy directly from the government of India and ensure that there is no chances of getting cheated, right? Well, this Indians spend 5 lakh crore rupees every year on importing gold. 1,000 tons of gold Indians import every year. 1,000 tons. Why? Imagine if this money was not sent outseas. This money could have been utilized at so many places: education, health, infrastructure, a lot of things. India is not a developed country. That it could splurge, it could afford splurging 5 lakh crore rupees every year on buying bullions, yellow metals. Doesn't make sense. By buying SGB instead of physical gold, you can do your contribution towards bringing towards making India a better economy, right? Well, this is the Excel that I calculated, this created. If you want this Excel, please comment below and I'll share it. I'll tell you what this does. You enter your the amount of gold that you want to buy. Let's say 20 grams, and these are the values, the ones in greens that you can edit. Making charges, if let's say jeweler is your mama, he'll just charge you 5%. Gold appreciation per year, I have assumed 10% based on historical values. It might be less than that given the good rally that it had in the last 1 year. Average inflation 6%. Economists believe that India's average inflation is going to be 6% for the next 10 years, so nothing to be changed here. Selling commission, again, if the jeweler or the agent is your relative, or you have direct contacts with the market, you may want to pull down this number, but otherwise it's typically 8 to 10%. Tax slab, change it based on whatever you fall into. So I have made two boxes: physical gold and sovereign gold bonds, calculated prices for everything, and based on this, uh, you know about 43% of returns based on these values. So what do you think? Now, coming to what exactly is a sovereign gold bond, how can you generate these returns? uh, Sovereign gold bonds was launched by RBI about 5 years ago. This was to cut down on the money that goes out of India in buying physical gold, and the scheme is quite super hit. The sovereign gold bond uh, December tranche is active now. You can buy it through your bank, or you can buy it through Zerodha. I have an account at Zerodha, so I just go to zerodha.com/gold, and therein I can place the order. You can do the same if you have the Zerodha account, or you can buy it through your broker. All the online brokers offer it. Just buy it as a diversification measure. Ideally, you should have your asset allocation ready. You know how much money you should be having in equity, or in debt, or in gold, and based on that, you should be calculating how much money you should be putting in gold, and just see if it's less than it, you should be investing in it. And again, the equity markets have rallied a lot. Everyone believes that it is overvalued. Well, no one can predict the market, but even uh, everyone thinks that it is overvalued. Do your analysis, and if you really think it's overvalued, what comes as a hedge for the equity markets? Gold. When people sell equities, they tend to invest their money in safer instruments, and gold is one of them. And that's why we see that the prices of gold might increase in the coming few quarters if the markets crash. And if they do not, well, you already have your investments in place, and they'll continue to do well. So I hope this video was helpful. Press the thumbs up if you really like the video. Subscribe so you do not miss how to make better money, my videos on these topics. Thanks a lot for watching this far.